Speaking of learning, let's learn a little bit with Jean Felipe Levesque. So Jean Felipe writes in, "Hi, David. I've been listening to the RBI podcast for the last year, and I love it." Well, thank you, Jean Felipe. "I'm on my way to listen to all available podcasts." Now, I think he means all available Motley Fool podcast, but he might mean all.
That is an undertaking.
That's Mount Everest.
That's a graduate degree in itself.
Jean Philippe, we may be misunderstanding, but if you are in fact purposing to listen to all available podcasts, write us a year or two from now. I want to share your journey. That's amazing. He goes on to say, slightly more seriously, "I am now a Motley Fool U.S. and Canadian Stock Advisor member. I'm glad to say I'm beating both indices in the last year. Here's a question. I live in Quebec, Canada. I spent a little time in Quebec City within the last year, and it's so beautiful, that historic part of your hometown." Jean-Philippe, thank you very much. "Typical recommendation for a stock portfolio is roughly 1/3 Canadian, 1/3 U.S., and 1/3 international to minimize foreign exchange risk and tax treatment of foreign investment." Now, Jean-Philippe goes on, "However, the Canadian market is less than 4% of the world market and mostly made up of energy, finance, and material. These are not my favorite investment sectors." He goes on, "At least we have Shopify." He adds an exclamation point. "Also, a lot of U.S. companies or U.S. listed companies, like, for example, Mercado Libre, are international. So do you care, gentlemen? Fools all. Do we care about geographical diversification in our portfolios?" For his individual stocks portfolio, he's 2/3 U.S., he says, and 1/3 Canadian.
Well, I think that there is a behavioral bias that's involved in his question too. So many people invest much more, maybe not Jean-Philippe, but so many people invest much more in their home country than in external countries. I'm one of them. I think every company I own is listed on a U.S. exchange.
It's actually called the home country bias.
Exactly. And that's not that damaging if the home country's exchange offers a wide range of selections.
That is true.
But France, for instance, is similarly a very small portion. Australia, a very small portion of the world market. And so that can hurt you and can get you into too narrow a range. So with you diversifying yourself outside like that, U.S. gives you a lot of variety. Internationally gives you more variety. I think you're doing all right there.
I think if you just look at, just say, he said John Philippe's a member of Stock Advisor Canada, in which we offer a U.S. listed and a Canadian listed recommendations every month. So I think that balance, Jim is right. While we do have a home country bias, the Canadian market is so small and tends to be very focused in those markets that John Felipe mentioned, which in our minds are not the most exciting, greatest wealth creating opportunities for any person in the world. Over the last 10, 20 years, those have really been focused in the U.S. markets, and that's why we tend to concentrate mostly in there, besides the fact that most of us live here. But we have a lot of global members who invest, and you can now invest much easier in the U.S. markets than you used to be able to. So I would say in general, the U.S. market continues to be one of the most exciting places to invest because it has the best companies, and I think that's not going to change in my mind anytime soon.
So having just got back from China myself, I recognize the importance of that economy, the number 2 GDP economy in the world. There are some great Chinese companies as well, and we've had them in our services. And I think in particular of Baidu, which has been a wonderful long-term performer, even though more recently it hasn't been great. Or just think about Tencent or Alibaba. These are really big world-shaping companies as well. Is it fair to say, as we conclude this one, gentlemen, that we tend to be go-anywhere investors here at the Motley Fool? Show me the best company I can buy, and I'm going to buy it?
I think so, Jim. I would say that we are looking for excellence wherever we go and wherever we can find that. David, Mercado Libre is another one that is not located here in the U.S., but it's just been an exceptional recommendation of ours, and that is not focused primarily here in the U.S. So we're looking for excellence, and we will go where we can find that. I think that's been predominantly in the U.S. over the last 20 years.
That's a fair point, but also I think there's been a shift in the in companies in themselves of the last 15, 20 years that might not have been taken into account by this kind of question, in that in your own country, the idea was the company gets most of its revenue from that country. And now with today's companies like Alphabets and Netflixes and Amazons and GM and Toyota and all those, Uber and so forth, their revenue is much more international, and so they're not exposed as much to the risk of like a recession in their own country.
Really true. So if you're really looking to diversify geographically, which I don't think we three purpose as a primary goal as investors, but if you are, maybe take a look at where their revenues are coming from, not just the market cap of where that company is based. All right? So thank you. And Jim Mueller, thank you for joining us this week on Rule Breaker Investing.
My pleasure.
Really appreciate your insights.